Welcome to our quarterly update for the ODCE Index with Garrett Zdolshek, who I'll introduce in just a minute. Also, I should open up by saying happy holidays, happy Hanukkah, Merry Christmas, happy Kwanzaa, whatever you like to celebrate. It's a great season. So thank you for tuning in. We really appreciate it. As you know, these sessions will be recorded. So if you want to check back later and look at the recording again, or share the recording with other people in your organization, you'll be able to do that. We'll send that to you in an email following the event. In addition, keep in mind that this is meant to be interactive. So we want to make sure you get your questions answered. So the way to do that is to use the chat feature and pose, a Q&A feature, which you see down in the bottom. If you look down in the bottom, there's a Q&A button. So click on that, enter your questions, and we'll do our very best to answer them all. Usually we get a ton, and we do our best to answer every one of them. Other than that, allow me to introduce Garrett Zdolshek. Garrett is the portfolio manager for IDR and the Accordant series of funds. And he is a former senior consultant with Cortland Partners, now part of Stepstone, where he was a member of the investment committee and very much involved in following all of the performance measurement indices that are out there in the marketplace, as well as developing their own. And since then, as the portfolio manager at IDR, he's been managing a series of ODCE Index funds. So ODCE is something that he really focuses on. And this is an opportunity to dive deeper behind the numbers that you can get right off of NCREIF's website and understand what's really going on behind the numbers. So without that, all further ado, allow me to introduce Garrett Zdolshek. Garrett, floor is yours.
Everything is going slow today with the holidays, Jeff, I think. Thanks for having me again, as always. Really looking forward to conversation today. And as Jeff mentioned, please ask questions as we go. I have a number of slides. I'm going to go fairly fast on a few things, but if something piques your interest, feel free to slow it down and ask questions. We will follow a similar agenda that we've followed in the last year or two, with first the ODCE update, where are we in the market today? Second, dive deeper into fundamentals, what's causing some of this performance. Third, capital flows as always. We'll talk about Qs. We'll talk about buying and selling. And then I thought, given that we're so close to year end, we'll touch on kind of performance we certainly see going through the fourth quarter, but also thought it would be interesting to do a market survey of managers in ODCE and get some of their views and aggregate them, of course, on what they see coming in the next few years in terms of sector allocations, exposures, and performance. So without further ado, I'll jump right into the market update. Similar slide we've seen in the past, and as a reminder, these are the new NCREIF allocation or property type diversification views or sorts. So you can see industrial and resi remain the biggest sectors by far. Office, which includes life science and medical office, may look a little higher than a couple quarters past because those sectors are included, but overall office does continue to come down. Saw a number of sales in the office category again this quarter. I'll touch on pricing. Retail, first time we've seen retail start to tick up in quite a while, and you're going to hear me mention retail a little more this quarter, seeing a number of inflection points there. And then, in terms of sector exposure across geographies, not much change really over the last year. West continues to be the largest exposure, followed by the East and South, which is higher. From a leverage standpoint, I'd also mention leverage is up slightly or I'm sorry, leverage is down slightly, and so equity is up for the trailing 1 year. Again, a positive sign with performance. In terms of the weightings, we continue to see office fall as you would expect, and we also I'm told my audio is a little low, Jeff. I'm gonna
Well, we can hear you fine.
okay, great. In terms of office, we continue to see office falling. Industrial and residential are largely flattening off, although with resi up slightly. Retail has clearly flattened. We expect that to continue to inch up maybe slightly with performance. And then you can see at the bottom, we broke out self-storage, which is its own asset class going forward. And then other, which is everything else that's not included under the breakouts for the main property types anymore. So it's small, but even that we expect to continue to grow a bit. And you can look at years past or quarters past where we've broken out all those nuances and details in detail. But overall, industrial's up 16% since 2019. I think it's a little surprised residential is up only 4%, but it's been a consistently large exposure in the index for quite a while. Office is down 17%. Retail is down 5%, which again I think is flattening and actually maybe even coming up a bit. In terms of performance, the 3Q25 return was just under 0.5% for the quarter total net return. And as you look back, we clearly are in a flattening and slightly rising period return wise. Obviously, over the 3 years, really where we see the negative impact now. We're continuing to see a positive 1 year return. 3 consecutive quarters, I think we've been in a positive trailing 1 year return, which is typically an inflection point. And so I think, it's fair to say probably the worst is behind us. And we have some kind of optimism going forward, which I'll talk about more. In terms of the broader markets, I continue to like to put some perspective on where is real estate in the broader, asset class universe. And so here I'm showing the public markets measured by the S&P 500 in teal. Can see public markets continue to reach new highs. And that certainly eased the asset allocation weightings of private markets in pension portfolios in particular. And you can see ODCE in blue and REITs in red continue to kind of bounce along pretty close to each other. And again, I think that is especially important when you think about pension fund and institutional asset allocations. We're really stressed over the last few years in being overweight private real estate. That has certainly eased with what we call the denominator effect of portfolios growing, and then by definition, real estate values coming down, but also the pie getting bigger. So very encouraging. Vast majority of clients we talk to today say they're below their real estate allocation going into 2026, that they have more allocation. They're very precious dollars, so it doesn't mean a flood of money is coming, but there is liquidity coming back. And for the right investments, there is capital available again, which we'll talk more about. Again, I kind of mentioned the public markets and private markets. As we look back over the long term, we're really seeing ODCE kind of came back to its long-term average over the last 15 years, about a 7% annualized total return. Certainly much lower volatility than the public markets, but also giving up some return for that volatility. To the right, you can see REITs, about 150 basis point spread, higher return, but commensurately higher volatility. And then you look at the negative returns or drawdowns, you can certainly see the balance. We get this question all the time, public or private. our view is both diversification is good. The non-correlation, in our view, is very good and a very important kind of consideration in building portfolios. So why wouldn't you want both? In fact, we think there's a lot of benefits to having public and private real estate in a portfolio. And then you can certainly see how that reacts to stocks and bonds. On the private side, we continue to believe we have reached an inflection point in performance. If we look back over previous cycles, we saw that once the trailing 1-year ODCE return, which is shown in the blue bars here, once that trailing 1 year turns positive, that's generally been a sign that we are at the bottom and at least coming into a recovery. Now, what I'll say is the recoveries have been very different, especially if you even just look at the 90s recovery versus the GFC recovery. They're not all the same. And we don't think this one will be similar or necessarily the same to either as well. If we look at the drawdowns, we are squarely in the middle. Worse than the 90s financial crisis, which was largely driven by, oversupply. And there's some similarities there, certainly, that we can talk about. But certainly not as deep as the financial crisis in 08, 09, which was largely a, valuation and a credit-driven cycle. And there are certain similarities to that as well, but they're not the same either. So as we look at the recovery, we're slower. It looks a lot more like the 90s, but longer term, we think we're going to end up in the middle as well. Probably not as steep as the financial crisis, but we actually see some improving signs coming pretty rapidly in the fundamentals that I'll talk about. In terms of thinking about performance and ODCE and it's the outperformers and underperformers, again, I think we see some similarities over the last few quarters and really through this cycle. The downside has been steeper than the upside by far. So we've continually seen an outlier, through this cycle drag the index down more than the outperformers could pull it up. I think that's pretty consistent with broader market experiences. There's always going to be more risk to the downside. So if you think about, just the spread, even in the third quarter, we were closer to a 1% total return without the outliers on the downside. And so I think we'll continue to see the market start to edge up closer to that 1%, return per quarter going forward. I think a lot of conversations we've had, especially over the third quarter and into the fourth quarter, have been kind of cleaning up portfolios, repositioning portfolios for success into 2026. And I think we're going to see a lot of that success coming. And I'll talk about the number of reasons why, but in particular, valuations are to a point we think they make sense. Transactions are happening at those valuations, and then liquidity is getting better as well. In terms of the drivers of this dispersion, in the financial crisis, it was largely driven by asset selection. So did you buy the right assets? It didn't matter if you owned office or retail or resi. As long as you bought high quality, quality credit tenant buildings, you largely perform better through the financial crisis because you have more stability. And this last cycle is very, very different. If you look at that blue line, the volatility by asset allocation or picking the right property type was actually even higher than fund selection. So if you're a portfolio manager and you could overweight your portfolio to industrial broadly and underweight to office, you generally did way better than market peers. And that happened obviously at a point in time where industrial did incredibly well return wise. But that has kind of come back pretty significantly. The fund volatility remains, and that's largely again driven by asset selection. So we think we're coming back into a part of the cycle where uh, volatility is driven by the real estate itself, not necessarily just portfolio allocation.
We have a question, Garrett. It says, what does a recovery within the previous recovery bands imply for 1, 3, and 5 years forward returns?
So, yeah, if we go back, it really depends, and it's very sensitive to timing. So if from here we see a recovery come back in between the blue and teal, we'd be in the high single digits to low double digits. But again, it's going to come back to timing and how long that recovery takes to think about time value of money. And that's something I want to touch about on in fundamentals much deeper because there's certain drivers we see that are going to matter a lot in that conversation. One of which is cap rate. And I think that's actually a good segue into cap rates. So cap rates, by and large, moved, and that's shown in the black dotted line from 3 3/4, call it. We're now up to a little over 4.5 cap rate today. And again, it's an important measure, right? Cap rates, but there's a lot of different types of cap rates that get thrown around. So to be clear, this is the 1 year going in cap rate, not to be confused by a 5 year pro forma or subject to a bunch of leases being signed and things like that. So this is a, pretty static cap rate. And so you'll notice like office fell, for example. That's because vacancy has increased, and therefore NOIs have come down, which is just lowering the cap rate number. It doesn't necessarily mean the building value has gone up, as values have come down 40 to 50%. So I think you do have to keep cap rate with a little bit grain of salt. Also in industrial, that doesn't price in renewing leases and rolling leases, over the next few years. And while we've certainly seen lease values come down off their peak, in many cases they are still up from a lease that was signed 3 to 5 years ago. So again, I think you have to take cap rate to a degree with a grain of salt. It is an important measure to think about, but it's not the only measure we should be looking at. In terms of just value increase or decrease, we continue to watch this pretty closely. And this is just by number of assets. How many assets quarter over quarter are being written up, are flat within 10 basis points, plus or minus previous value, or written down? And we continue to see those metrics get better, right? Where more and more assets are predominantly being written up or flat than down. And that's certainly easing some of that performance pressure as well on a go forward basis as portfolios get marked where they need to be. It's also evidenced by the lack in negative return across the board by sector. So this is showing quarterly return contribution by sector. And you can continue to see that, residential is now the biggest driver of performance, followed by industrial, but industrial is a much smaller piece of that in blue. And then even office and retail as a whole are marginally positive. So as we think about that performance over the last few quarters, a couple interesting things I think we've seen. If you look over on the far right, the blue industrial has performed below ODCE for the past 2 quarters now. That's something we haven't seen in a very, very long time. And remember, these are unlevered returns, so no impact of leverage. But I would also then point out, retail has been quietly having a pretty solid performance year again. It's coming down a little bit, but if you look over the last kind of 2 years, retail has really actually not been the detractor of performance by any means. It's actually been one of the best performing places to be. And then, self-storage is another place I think you have to mention here in green. While it's a small part of the index, it's continually to be, pretty solid performer, quarter over quarter, kind of bouncing between, first and third performance wise.
What's
So,
data centers?
oh, yes, partly. And it's a small part of the index still, obviously. The other category also includes some of these other, smaller pieces like, and I'm looking on the right here in terms of kind of industrial flex or what else is in there? Single family rental, small pieces of the portfolio. But I think a couple interesting things. One is, yeah, industrial data centers are by far the best performing subsector. Small part of the indexes are not a lot of stabilized, newer data centers to own to begin with, but very good performance. But on the other end, I would kind of point out too, predominantly all these subsectors are positive performance over the last 1 year, with the exception of office, life science, industrial life science, and then just office urban as a whole. So, again, broad brushed positive performance, across the index with a couple outliers. So while performance will improve, it's not going to be, perfect across the board. What you own will continue to matter. So I kind of promised I'd talk about some of the drivers of that performance and where we see, the market either recovering or being stalled a bit. And we'll kind of hit that here in this next section in fundamentals. From a broad brush, I'm not a economist, but I think it's important to pay attention to inflation, which, again, continues to kind of remain stubbornly above 2% and kind of right around that 3% range. That may bounce around for a while. And I think on one side, the Fed is paying a lot of attention to that, as they should. I think on the other side, though, we're starting to see some of the reasons for some of the concerns and even the most recent rate cut, and unemployment remains low, but starting to creep up, kind of consistently. I think today this number was actually just revised up even a little further. So, you have very conflicting mandates here for the Fed of low inflation and strong labor. I think we're going to kind of continually see these clash for a little bit as we go through the next year. But the good news is finally, ODCE cap rates are remaining below the Fed's funds rate. And this number does not include the most recent cut that happened last week. So, today this spread's about 100 basis points. And that's probably not enough long term, but it is certainly part of the reason why, there's some more optimism and I think some more patience in the market today.
Two questions, Garrett. One is, with the AI hyperscale build out over the next decade, what expectations do you have for specialty real estate makeup of the index? In other words, do you expect other category to grow?
We do. And we did a survey and we can show you the results of where we think that will go. I think the other thing I would say to that, and I think it's a very good point, AI is kind of a generic term. It means a lot of things. So, whether it's data centers in particular for real estate, but I also think it's going to have a lot of other, uses in the digital economy. We're seeing self-driving cars; those require different services and support, and the list kind of goes on from there. But I think we're going to see new uses of real estate. I think we're going to see real estate transform a bit, in this digital economy that is natural for kind of, generational changes. It doesn't mean I believe all AI is, the gold standard is going to be perfect and, everything that really relates to AI is going to make money. But I do think it's going to create a lot of opportunity in real estate.
We had a research roundtable discussion just the other day, and one of the researchers pointed out that AI is one of the drivers, but not the only driver of the growth of data centers. And sometimes it's a little overly focused on the AI component. Second question for you, Garrett, is the Odyssey brand has been severely damaged in the past few years with lousy returns, concerns about appraisals, and illusory liquidity. What's it going to take for Odyssey to return to a place viewed favorably by the investor community? Also, what are the chances that the consultant community will actually put pressure on managers to honor redemption requests and clear their queues?
Sounds like it's anonymous, Jeff. Sounds like a closed-end fund manager. But look, I don't actually think the brand has been severely damaged. I think it's a representation of what's happening in private markets and private real estate today. I think as we look at performance, I think it's an accurate representation of what a lot of portfolios are going through. And so I hear a lot of conversation around comparing Odyssey to, in one case, Core Plus or, non-Odyssey funds that are open-ended. And, I think it'd be interesting to see a kind of broader brushed, kind of return and liquidity analysis on the broader market. I don't believe it's much better than Odyssey. In fact, I think it could be worse. I think then, if you're comparing closed-end funds to drawdown funds, we're in a whole different conversation. So I'm not sure what you're getting at there, but I don't think you can compare an open fund time-weighted return to an IRR. I just don't think those conversations equate. Lastly, we'll talk about liquidity, but I think liquidity is getting better every day. Payouts are happening. The queue has come down again this quarter. But I think it is a two-edged sword. You have today, call it, less than the exact number, I think is about 12% of the market wants redemption, but the corresponding rest of investors don't want assets being fire sold. They don't want the best assets in portfolios going away because they want to continue to own those assets. So I think it is a delicate balance. It's certainly not perfect, but I also don't think it's non-representative of what you face in private markets. You don't have perfect liquidity, and it's never been promised to be perfect.
Well, never is
Fair
I would
enough.
argue that
Someone somewhere has.
some people overpromise and underdeliver, and it's an unfortunate thing for the industry. I have another question. Long-term yield curves remain elevated despite Fed cuts. Do you think Odyssey cap rates reflect this broader market expectation for long-term interest rates?
No, I don't. I think they reflect the shorter end of the curve. I think, because of that, we have seen lower returns coming out of this cycle. And it's done a dovetail right into the next part of this conversation of what's required to catch up. And so I'm going to answer this, but I'm going to answer this in a long way because that's actually a great segue to kind of what we see, down the pike. And that's first, historically, cap rate expansion. So the spread, especially if you think about spread to 10-year treasury, has been driven by interest rates coming down more so and significantly more so than cap rates going up. The reality is, these assets are very lowly levered. There is no debt pressure on these types of owners. And so they're not going to be forced sellers into an unfavorable market for the most part. So you'll see some forced selling because of debt, but largely capital is available and it's keeping, cap rates, I think, relatively low. So, then that comes like, what's next? So what's that mean? And bear with me here, but I think it means a couple things. So from a valuation perspective, we are seeing Green Street market prices, so sales, align with ODCE appraised values now fairly consistently for the last few quarters. And notice how flat both of those things are. So, we probably reached the bottom sometime in 23, maybe into 24, but probably saw the height of that distress in the late 22 and into 23. So I think, spot pricing, by Green Street would tell you it went down more than ODCE. But now that spot pricing has come up a bit. So they're aligning more with appraised values today. And in fact, they're very close if you equal weight them.
And here's a question. Have there been any industry discussions on how to improve the valuation process when transactions dry up?
Yeah, I think there's a lot of that conversation. Altus and Citus. I really think they're doing their best, and they're trying harder than anyone to find value. But when there are limited to no transactions, or when you're limited looking at distressed sales and trying to come up with a value that a rational owner would sell at, those are two different things. So if we want pure spot pricing, we should just buy public markets and live with the volatility, uncertainty, and change in value every day. Private real estate is not meant to do that. So, again, I think both sides of that are a trade-off. I'm not telling you one's better than the other, but I think expecting, irrational results from the sector you're in, is also irrational.
You know, just to the question, there was a webinar produced by the Counselors of Real Estate that I was privileged to moderate called Crisis in Appraisal Land. I think you can probably find it on the counselor's website, certainly on ours, or on YouTube. And we had people from across the pond, from the UK, as well as from the US appraisal community, talking about just this issue. So if you're interested in it, you might want to dig that up and take a gander.
Yeah, Jeff, that's a great point, right? And also in different regions of the world, I would argue certain places are more apt to mark faster and severely, if you will, in either direction. I've also seen other parts of the world that mark even slower than us and are more illiquid than us. So I think it is a balancing act. That investors will continue, and managers and appraisers. I think the whole community will continue to discuss it, and I think it's very healthy that it's being discussed. And hopefully that continues. I think in terms of value again and kind of the forward view, a big thing that we keep hearing is construction costs. They went up significantly with COVID, and then the blue line is kind of the dark blue is showing you where we see construction costs as measured by the U.S. government without tariffs, and then a kind of view on what that could look like if everything's tariffed and at kind of the prevailing rates they're talking about today. That spread is anywhere from effectively 15 to 25% to today's market value. Now, I'm not saying every asset can be measured to replacement cost. The older it is, the less relevant it certainly becomes. But there's been a lot of newer assets coming into supply over the last kind of 2-3 years, especially in apartment and industrial. So as that valuation went down below replacement cost, it effectively slowed down the new supply. One, because values you can buy below replacement cost, but also that new supply probably created a little bit too much supply. And so rent growth, on the other hand, kind of came down pretty sharply in 24, 25. Largely the forecasts we see, and these are forecasts going forward from 26, show an improving landscape on that supply and demand side of things. And so with the new supply largely being cut off, down 54%, we think, the next few years could look pretty good from a NOI growth perspective and bring some of those values, up closer and towards that replacement cost number again. But it's been very slow. It's practically zero if you look at the year-over-year change in ODCE. So one of the things we kind of mentioned earlier is what is the catalyst and what do we need to see going into 26 to see values get higher and returns get better. We would submit more than anything, we need to see more NOI growth come back to the market. So inflation remains above that 2%, right around 3%. Typically we would expect to see real estate NOIs catch up. I think we're seeing that in the projections. I think we're seeing that from a supply demand fundamental point. We believe that should happen, but I think we need to see it in reality for values to kind of catch up to it. We do have time though, because cost of debt, 75% of ODCE is fixed rate debt. Certainly the floating rate debt got up close to almost 7% at its peak. That is eased down into the fives. But when you think about weighted average, we're still, well below 5, kind of in that 4.5 range, and have some runway for that to go because of maturities. Less than 15% of the portfolio maturities will roll per quarter. So there's still a lot of staying power and patience left for owners of quality real estate today to wait for that NOI to pick up. Okay, we're on pretty good time here. So capital flows are next. And I think kind of mentioned this earlier in the year, tariffs were announced in the first quarter. That typically has a bit of a lagged effect. So we really kind of felt like, through the rest of the first quarter, but especially into second quarter, tariffs were a pretty good overhang on the market again as investors and owners kind of took stock of what they meant. How severe were they really going to be? I think a lot of that initial fear, while there's still certainly conversations and rightfully so a view of it, I think a lot of the major fears have dissipated a bit. And so certainly saw a recovery coming into third quarter in terms of transaction value, with acquisitions and dispositions up materially over 1Q, in a pretty good clip over 2Q. I think one of the differences we're seeing is the purple. So retail on both the disposition and acquisition side, is much stronger now. I think the demand to own it is back. Seeing a lot of discussion around retail, especially grocery anchored, by the way. There's certainly still but what kind of retail? Are we talking mall or grocery anchored? High quality mall has been actually doing really well, quietly. And then grocery anchored has also been doing well. That's the majority of what's in ODCE, those two sectors. So seeing more liquidity in that area, and a lot more buying and selling. I think the other interesting thing is notice office was about 30% of dispositions last quarter. Again, I think it's showing, office at today's marks, largely in these portfolios, can be sold. There's a wide swath of considerations still, though, in terms of location, size, quality. It makes it very difficult to talk about office as a single sector without comparing some of those nuances. And then finally, residential certainly remains a very liquid sector of the market. But I'll also kind of just point out there's more selling of industrial this quarter than we've seen for a long time as well, which I think is also a small shift in sentiment that, industrial is not necessarily the no-brainer it used to be. So net investor cash flows, I think, and these are just, if you remember, these are actual cash flows. These are not Qs. This is money that actually moved in and out. The weighted average continues to be net outflow, just close to $2 billion. But again, I think it's encouraging to see more inflow and outflow on both sides of the pie here again on a quarterly basis. A little less actually than 2Q, but again, I think there's also a lag effect. And then, in terms of payouts, the net redemption payouts picked up again from 2Q. So again, another encouraging sign. It wasn't quite as high as 1Q. I expect to see 4Q pick up in terms of, we're hearing a lot of portfolios and a lot of assets are in the market for sale. It's obviously hard to know for sure what ends up getting sold or not sold by year end. But there's generally a lot higher transaction volume at year end. So I would again expect to see this kind of net payout number increase into 4Q. Overall effect is I think Qs have continued to, notch down a bit again. We're kind of in that, I think, just below 12 or right at 12%. Actually, a little bit below 12% net Q out of ODCE. We are seeing some more money come in, but largely that's being drawn when it's committed. And you can kind of see there was a brief pause with tariffs, but the payouts and the Q continues to move down now that we're kind of past that a bit. Lastly, I think from a market sentiment or view, again, some positive outlook here. So if you think about investor impact, that is new investor basically new investor requests. So whether they rescind or add new requests for redemption, that's in that kind of net investor impact. So there were, again, some more redemption requests that came in 3Q. At the same time, I think they're much farther down from the 2Q impact of tariffs. And then, the redemption payments, about $3 billion of net payout, or gross payout, I guess, from the underlying funds gives you that kind of $2 billion net impact, of Q reduction. So again, I think we're moving in the right direction. It's not no-brainer, broad brush, complete liquidity back to the market, but things kind of do continue to move in the right direction here, I think, in the third quarter and into fourth. Yeah, I'll pause there. Not a lot of questions at year end. I think everyone's ready to call it a year and move into next year, Jeff. But maybe I'll spend a few minutes on the market. Oh. So going back
on the redemption paid, what happened in second quarter for the decline versus first quarter and third quarter?
Yeah. Okay. So great point. I know this can be a little confusing, but essentially what that top line green number is looking at, or green bar is saying, is what did investors do? Did they put more redemptions in, or did they have more rescissions? And so we're netting that kind of new redemption requests with rescissions. We're netting that out. So in 4Q24, we actually saw more redemption or more rescissions than redemptions came in. In 1Q, we saw more redemptions come in because of, in our view, tariffs and the concern, and that really flowed over into 2Q given kind of the lag we generally see. So we saw, tariffs largely drive more outflow from the ODCE market, or more requests for outflow. At the same time, that blue number is showing the underlying fund payout, like what they're actually paying in net redemptions, from asset sales or inflows of capital. And so you net the two, and that gives you that blue, or that gives you that black dot, which shows you kind of the net effect of that red line, if that makes sense. So each quarter we kind of continually saw that redemption queue come down into 4Q, 1Q, and then it went flat in 2Q because, the new inflows matched the outflows effectively. We're back onto a trajectory where we're seeing more payout, and we're seeing more impact to declining, to reducing those exit queues again. Okay, so I mentioned a market survey, and so what we asked.
One more question until we get there. Actually, two more. What sectors will you be vigilant on, anticipate additional value declines in?
So I think that's a great question. And, candidly, I think it's not as much about sector anymore. I believe it's more about market fundamentals and how they affect the sectors. If you look at the quarterly returns, they're all positive now, including office. I think a lot of the value decline is off, but I think it becomes now more of a relative conversation of what's an outperform and underperform. And so I think, industrial obviously had a huge run up. If you're a big reversion, believer in reversion to the mean, I think you have to wonder a little bit about some industrial, right? Especially industrial that's not leased. How long does it take and at what price versus assumptions, and does that have some value impact? I don't think that's the majority of ODCE industrial, so I don't think it means necessarily ODCE industrial will decline in value, but I think it could mean returns going forward could be slow or low, especially relative to some of the other sectors that took their medicine on a value perspective. So I think it's more relative. To sum it up, I don't necessarily think you're going to see broad brush negative returns in any sector right now.
There's another question, which is from a valuation perspective. Do you believe there's a consistency issue among appraisal managers and or third-party appraisers that result in wide dispersion among funds?
So no one ever liked the real estate they owned as much as the owner of the real estate, right? I think we all have a propensity to think and say, our real estate is better on this corner, or, because the design or the corner location or this, that, or the other thing is better. And that's what makes real estate so hard to consistently value is, even two buildings across the street from each other arguably have a lot of differences in terms of potentially age, tenancy, floor plan, etc. So I think it's an easy thing to say that, oh, my performance is different than that performance because I'm valuing things better than that guy, or vice versa. When we look at and try to look at apples to apples comparisons, our conclusion is the opposite, that we actually believe the valuation firms in particular go to great lengths to try to value assets very consistently. They might just have very different lease rolls. They might just have very different ages. Like there's a lot more than just square footage and age that comes into play. So the short answer is I actually think it's much more consistent than we give it credit for.
Thanks.
All right, the market survey, Jeff. So we went out and asked the ODCE constituents largely two things. Where do they see portfolio weightings by sector go over the next couple of years? And I don't think the broad brush would surprise you, but we took those responses and views, weighted up, value weighted it back into ODCE. And so here were the results. Industrial marginally starts creeping down. I think that's kind of a function of pricing and go forward return. Residential, I thought was kind of interesting that very slight decline, but again, a decline. Office, I don't think is a surprise at all. And by the way, this assumes performance is equal among all sectors. So this is not moving weightings by performance. So I think office, about 3% of that is life science alone. I don't think it's a surprise. We'll see less office in a portfolio. I wouldn't even be surprised if it's closer to 10% or so. First time again, I think the sentiment on retail has shifted. Finally, it's been a long time, but I've even had kind of investors over the last year kind of say, we're starting to look if we can invest in like a retail fund, and there's like virtually nothing out there. It's just really hard to get exposure in fund world. So I think that'll probably even get a little better. Returns seem pretty good there for the most part. Self-storage, I was a little surprised, it's 4% of the index, but effectively it's going to go up by 50% if that's correct. So I think that's a pretty big jump, but I think again, representative of the fundamentals and the forward return outlook of the space. And then other, again, just a lot of kind of niche and non-traditional sector exposure, which again is, I think, just driven by the outlook and the kind of search for yield and return.
Question is, what about credit funds? Credit funds really aren't part of ODCE, are they?
No, and in particular, like if there was any, so other does include like preferred equity or mezzanine loans or first mortgage loans. Like I think it's less than 1% of the index, but there is a very small kind of structured note type of component in ODCE. Lastly, we asked about return. So, again, this is gross unlevered return view. I think it's pretty down the middle in terms of kind of total 7.2% unlevered gross return. I think a lot of the net kind of after fee calculation depends on what you view the cost of debt as being over the next 3 years. Remember, ODCE funds have about a 4.5% cost of debt. So, that's fairly accretive. That would be pretty good, probably. I think the big surprise is probably seeing industrial to the right of that 7.2. So, by and large, the view was industrial and office will underperform and the other sectors will outperform. I think it's very comforting actually to see residential right in the middle there. Typically, as much as we like residential and feel like it's an outperformer, it's actually performed very similar to ODCE as a whole. But again, I think that's kind of representative of the wide swath industrial represents, from high-rise city all the way to now SFR and suburban and kind of garden apartments.
And there's a question regarding residential. Is there dispersion in residential with single family rental up and multifamily rental down?
So yeah, we can look at the dispersion, and I think if we look three from the left, we have residential manufactured housing, 12% return. So I think manufactured housing has been doing really well. I think SFR has and in particular build to suit. SFR is largely what ODCE managers are interested in buying because it's more apartment like in a community rather than dispersed sites where you really need a specialized operator in particular. So I think the SFR has been a little slow just with the residential run up. The land values have gone a little higher, and it's been a little harder to build those of recently. But I actually have a pretty optimistic view on both those sectors going forward.
And there's another question. Are these return assumptions going forward based off ODCE's current valuations cap rates?
Yeah, I think they're the forward-looking time-weighted returns, gross unlevered for ODCE, going into 26, 27, 28. So as if you came in January 1 of 26. I think last I'll just leave a parting comment. I think it's not going to be a linear line. In other words, I don't necessarily think 26, 27, 28 are going to be the same return. In fact, I think, as we kind of see it, probably 26 will be a little slower, 27 will pick up a little more, and then, 28. So I don't think you can view it as the first year return will be the same as, the next year's return. So we're almost on perfect timing there, Jeff.
Yeah. So thank you, Garrett. And thank you, everybody that tuned in. Happy holidays again to all of you. The next time we're going to come together will be in the new year in 2026, where we'll take a look at the final returns for 2025 in the ODCE Index. And when you come next time, really encourage you to have your questions kind of in hand because we can make this a lot more interactive, even though we appreciate the interaction that we got today. Again, happy holidays and happy new year. And Garrett, thanks so much for all the prep work that goes into preparing for this.
Yeah, no, thanks for having me. Always enjoy it. And thanks for all the questions.
You bet. Take care, everybody.
Take care.